This is a very brief introduction to support and resistance and how this can help you with your trading from the Society of Technical Analysts. So the definitions and importance of support and resistance. A support level definition is essentially where buying pressure prevents a further price decline in market. This is where the market enters and starts to buy. Resistance is where you see people starting to sell. And why is this significant? You need to identify what are the key supports and resistances. Not all support and resistance levels are created equal. Some are far more important than others. And this is what determines that these levels are important and how we can use them to develop trading strategies. So how do we go about identifying them? We need to just take a look at the charts and observe by studying past price highs and lows and understand the market behaviour. So a previous high, for example, will create resistance. A previous low will create support. Trend lines and moving averages also help identify key price levels and influencing market movements. An uptrend is going to provide support for the market and a downtrend is going to provide resistance for the market. Accurately identifying these key supports and resistance levels can help you improve your timing for entering and exiting your trades. So let's take a look at this in practice. A previous high creates resistance, and when this level is retested, the market is again rejected by this level. It gives you an opportunity to sell the market. Your stops go just above the previous high. When you do it for support, the market sells off to a certain level and recovers. And again, where this is retested later, this provides you with another buying entry opportunity. You buy dips down to this level and your stops go shortly below that. This is an example of when previous resistance is broken and it then becomes support. So in July 2024, where we saw the S&P peak around 56.70 and subsequent tests in August and September also failed. However, once it's breached in late September, it then acts as support, providing buying opportunities. So this level then goes on in November to provide you with another buying entry point for your trades. It's good to think about the psychological factors influencing these levels. Trader emotions really do impact. Fear and greed strongly influence trader decisions. So as the market approaches a key level of support, there will be people who are already in the market and already long. They will be looking to add to their positions and possibly buy it. There will also be some people in the market that are short and they are wondering if this dip lower is going to hold or not. Once it does hold, the process of fear will start to erode their confidence. They're in a market and they're short and they need to think about, hey, that support is now held. Is the market now going up? Am I about to lose money? And they may consider, for example, cutting their positions out. So there's quite a lot going on at these support levels. Even if people are not in the market at all and hold no position, once it goes down and tests the support, they'll be starting to think, oh, is this a good place to enter the market and in fact get long? There's a lot going on at these key levels. This is an example of a week chart. It's a very long-term chart. It's a monthly chart. And this is the example that we saw in 2023 price action around a previous historical high. Not only did the market fail at this level, but the rapid approach and subsequent aggressive sell-off was very similar to the price action that we saw in 2008. We drew a parallel channel from the lows we saw in 1977 and 2000 and connected a parallel line from the 2008 peak. You can see that the market failed almost exactly at the top of this channel in 2022. So how do we apply support and resistance for trading strategies? Quite simply, you buy as the market approaches support because you know that the market should rebound from here, and you sell when the market approaches resistance because you are expecting to see selling pressure emerge. And let us not forget that once these levels are breached, they can also act as a breakout trading opportunity. They can indicate strong moves and potential profit opportunities. This is an example on an Amazon weekly chart. First of all, we look at resistance. In mid-2021, the Amazon share price hit 188.65, where it failed. And the retest of this level a few months later at point A provided you with another selling opportunity. So the trading strategy would have been to sell rallies to here and put a stop just beyond this level. Very good risk reward. And in 2023, the market made a low of 81.43 before it started to rebound. So dips down to this level would have offered a buying opportunity, point B. Please note that even if you'd missed this, once it cleared the previous reaction high at point C, this would have given you another buying opportunity. Why? Because a definition of a bear trend is for low reaction highs and low reaction lows. But once it cleared point C, the market was no longer in a down move, and therefore a buying strategy would have been more appropriate. So what are the common pitfalls and mistakes? Here's three. Misidentifying levels. That's going to result in misguided entry and exit points. Ignoring volume confirmation. If a level gets broken, you'd like to see volume increase on that break. And lastly, an over-reliance on support and resistance. Using only support and resistance without other tools limits your trading strategy. So how do you gauge how strong a support or resistance level actually is? On this example on the Euro-Yen daily chart, we've identified a key level at 159.65. And you can see that in March, this acted as key resistance. Now, this level, once it's breached, became support. And we identified this as a key pivot point. What does that actually mean? Well, if the market is above the pivot point, then it's positive. And if it's below the pivot point, it's negative. And how strong it is can be gauged by the number of times it's tested and the magnitude of the rebounds. We can see, for example, in February, that test provoked quite a sharp sell-off. And when the market was breached in April, that test and rebound from it resulted in a strong rally. In August of the same year, once that level was breached and the market broke below there, it actually accelerated very sharply lower. The subsequent rebound held below that level and the sell-off was again seen. So this was clearly a key level on this particular market. This is another example of a pivot point on the gas oil monthly chart. 363 is a major pivot and has acted as both support and resistance and provoked absolutely huge moves. In 1990, in the early 2000s, and in 2003, it acted as resistance. But once it was breached, the subsequent sell-off seen in 2008 sold off to that same level and provided major support. It's a really good idea to integrate support and resistance with other technical analysis tools. So using things like an RSI and a MACD alongside the support and resistance is going to enhance your prediction accuracy of price movements, but also use things like trend lines, moving averages, Fibonacci levels. These can offer much better market insights and improve your risk management. I personally like to include Ichimoku clouds. I find these work particularly well. So what makes levels key? Key levels of support and resistance can be determined by deciding if that level breaks, it will make the chart pattern more bullish or more bearish. They can be determined by a cluster of analysis, for example, a reaction point, a moving average, and a Fibonacci retracement all at one level would determine that that level is key. They can also be key because of the number of times they've been tested and held, or even the length of time they've been in existence, or by an emphatic rejection. This is an example of an LME lead chart. We saw a 7-year low on the market at 1535. It was the 2010 low. You will notice that when the market sold off to this level in 2016, you saw a major rebound from it. But also note that this support level was reinforced by the 200-day moving average. This level was extremely key. If the market had not held here, it would have tipped the market into being bearish. The fact it held and provided a strong rebound suggested that the up move was still alive and well. Let's look at some further real-world applications and case studies. Now, the one thing I do like to do is study charts of different timescales, i.e. monthly, weekly, daily, and on each chart identify support and resistance levels, and then I find the common denominators. So an example of how you could use this is on this crude oil chart. So on the crude oil chart, on the weekly chart, we can see that the market has been approaching key support at 55.12 to 30. This is the weekly chart, and that identified the key level of support. When we drop down to the daily chart, we could also see, as it was approaching it, that the daily RSI was below 30 and therefore approaching oversold conditions for this particular market. So a reasonable trading strategy would have been to buy the dips down to 56 and put your stops below 55.12, looking for a rebound. I like to watch for convergence of support on a market, and this is an example on the silver daily chart. So during 2023, silver found resistance around 26.06 down to 25.90. Then in May of 2024, this previous resistance was tested and held, becoming support. In August of 2024, the market again sold off to this level, and we noted the following. The market is now in an up move, and the support level was reinforced by the 200-day moving average. See that brown arrow. So a reasonable trading strategy would have been buy dips to 26.06, down to 25.90 and place a stop below the 200-day moving average. So what do you need to know about support and resistance? First of all, you need to think about it as being a price zone, not just a single level. The more often that it gets tested, the more likely it is to hold. If a support or resistance area has capped the market over a long period of time, and we're talking maybe months and years, it's going to be far more important than one that's only held over a short period of time, such as on an intraday time frame. Psychological levels are important, so movements around 50, 100, 1000, for example. It is wise to assume that previous highs and previous lows are going to offer significant support or resistance levels. When I used to work in a dealing room, the dealers often used to remember where the market had failed previously or survived or bounced off levels previously. Support is more likely to be breached in a strong downtrend, and in a strong uptrend, resistance is likely to be breached. Now, if we're in a weak trend, say for example we're in a weak downtrend and the support is holding, that is also giving you some information. It is suggesting that the trend is losing steam. According to WD Gann, a fourth test of a horizontal support or resistance level often leads to a break through it. So that's worth watching out for. What's our conclusion? Support and resistance are essential concepts in technical analysis for understanding price behaviour. They help traders spot critical price points where prices might reverse or pause. Try to combine support and resistance with other tools because it does improve your market analysis and trading outcomes. This is information provided by the Society of Technical Analysts. We hope you find it of interest. If you'd like to learn more about technical analysis, please go to www.technicalanalysts.com and you will find information about how to join the Society and attend our monthly meetings to learn more about the subject. Thanks very much.